Investors are in love with their 4% plus bond yields. But is that a thing of the past? Will investors flee to stocks as yields drop? Let's talk with two big bond ETF authorities. Joanna Gallegos is co-founder of ETF firm Bond Blocks. Jerome Schneider is PIMCO Managing Director and Manager of the PIMCO Active Bond ETF, that's BOND. Joanna, I know we were talking before, you're telling clients they should increase their allocation in fixed income. Why, and what specific areas of fixed income do you like now?
Well, I think fixed income is very different today than it was 2 years ago at the beginning of all this volatility. First of all, we are nearing the end. We all probably agree we're at the end of the great rate hike. So rates are high, and that makes a lot of difference in a portfolio today than it did when we started out with rates being almost at zero. So it can be really important to start looking at fixed income as you diversify and you manage more risk.
So tell me a little bit about what you like, though. You were mentioning moving out on the yield curve as well. Give me some examples of ETFs that you sponsor that you like.
At Bond Blocks, we are about precision and being able to pick your spots in this opportunity set in fixed income. And so one of the intuitive things that we were talking about as we came into the show was, as you're moving out of cash and you're looking for the next opportunity, a very simple thing to do if you're not ready to take on any credit risk of the corporations is you can move out in duration. You can move very simply out into the 2-year, 3-year, 5-year. You're not going all the way to the 10 and 20-year, which we saw last year. When you get that trade wrong, it can be very volatile, and it has been volatile this year. At Bond Blocks, we were talking this morning that, I think the 20-year was down 10% at one point this year, and now it's up 4%. So something in the middle of the curve might be a great next step.
So on treasuries as well as corporates here. So I see you have the 5 to 10-year triple B corporate bond, that's BBBI. So you're right in the middle of the yield curve there with the Treasury, XFIV, and the BBBI, right?
Yeah, and so the triple BI, what's interesting to talk about there is, when people think about high quality credit, they think about investment grade. And so their first thought is sort of in the A rating category, AAA, single A, double A. And what they don't probably realize is there's an immense yield pickup as you move to a triple B. So triple B is still investment grade. It has a very low, if any, default rate risk at all. And you're picking up, I think I checked just a minute ago in the intermediate product, triple BI, you're picking up an extra 80 to 90 basis points in yield. Just by going up a small, going into triple Bs a little bit, you're still getting investment grade, you're still getting really great quality.
Jerome, you manage one of the largest actively managed bond funds, bond ETFs in the world, PIMCO Active Bond ETF. BOND is the symbol, folks. How much will the Fed cut in September? Let's get that on the table. And what are you doing now in that actively managed fund?
The Fed would like to cut about 25 basis points or so, just simply because they're focused on being sufficiently confident in that inflation beginning to ebb back to more normalized levels. But the growth prospects, and there's a lot of data, Bob, between now and September, but the growth aspects is really what the market is going to be very focused on, which is why we're sort of perceiving at this point in time, the market is perceiving a potential for a 50 basis point or even some intermediate cut before the next meeting in September. And while that's not our baseline prognostication here at PIMCO, we do recognize that this is the beginning of the easing cycle, and we have to rationalize what that means for fixed income investors more generally. Number one, that cash rates, those in money market funds, are going to see their yields ebb as soon as the Fed begins to cut that rate, and it could be pretty quickly. Secondly, we also see the value of owning a little bit of interest rate exposure. Again, favoring the front part of the yield curve is a place that we think is most attractive at this point in time. In the 2, 3, 5-year spaces, there's plenty of opportunities across diversified portfolios to look. And so as we continue this rate cutting sequence, the precision of what the actual rate cutting sequence has isn't necessarily as powerful as having a diversified approach which offers additional high quality spread and income along the way. And I think that the main takeaway for investors is this, is that they're entering these market conditions with a generally underweight posture to fixed income. Recognize that there's a lot of different avenues to participate in fixed income, and that takes an active hand in that. And at the same time, while guessing what the market is going to do in terms of yields or the Federal Reserve is going to do in terms of rate cuts might be something that people would like to do, what we're seeing here is that there are better risk-adjusted returns by being in an actively managed fixed income diversified portfolio than there have been in many years. And that's where the invitation is wide open still even as rates have begun to rally, for investors to begin to take advantage of those quite attractive total returns at a lower volatility point.
It's still amazing to me. 1 month, 5.3%, 10 years below, 4% now here. Same question for you. There are expectations the Fed could cut 50 basis points in September. I know you're not an economist, but will they do that, or what are you telling clients, or will they be more measured?
Yeah, I think the Bond Block's view is that the Fed will be more measured. We are not calling, and we don't see a 50 basis point reduction in September. We think that given the economic data from last week and where we're at today, that it is pretty certain that maybe a 25 basis point cut would likely happen in September, and that's where we stand. We think that we need more time and more data to iron out where we're at.
Yeah, is the yield game over at this point? I mean, if those people, the viewers, I can tell you, I get emails. They love this 4%. Anything over 4%, they perceive a positive real yield, inflation adjusted yield. Can you still get north of 4% and stay on the higher quality end of the bond spectrum?
Yeah, you're definitely. I mean, I think it's now more than ever to take a look at the different opportunities in fixed income. You have to be able to see them, and so we launch products that you can see lots of different cuts of treasury yields, lots of different cuts of the way credit is yielding across investment grade and high yield. So we look at this all the time. We can't stop focusing on yields north of 5% are in investment grade, and even further into high yield. Now, it may not be your cup of tea today to talk about high yield, but the truth is that we still, and we're hearing a lot of commentary today, that fundamentals still look strong for corporations. And especially in the higher quality cuts of investment grade, and even in some of the higher quality cuts of high yield, there's opportunity north of 5, 6, and all the way down the rate spectrum down to 12.
Yeah, so. But Jerome, she brought up high yield. Give us your thoughts on this. I mean, obviously, there's a risk here, a default risk that's very real if the economy slows down. Where do you come down on the high yield side?
Yeah, we're beginning to see the need for differentiation, how market risk is being assessed, is being implemented, and ultimately tolerated. And part of that is to understand the profiles of the underlying credits. First and foremost, let's be clear, this is an environment where having resources, both in terms of the understanding of how a corporate balance sheet is going to evolve in tighter liquidity conditions, is going to be important. And having differentiation across the sectors, whether it's high yield, investment grade, asset-backed securities, is going to be incredibly important. So actively navigating these landscapes and just sort of honing in on a yield and a specific sector because of that isn't necessarily the right ingredients for success. Instead, we say that there are probably components of high yield, and admittedly today, or over the past few days, the lower rates we've seen have actually probably benefited some of those high yield issuers from coming back to market who have tighter liquidity conditions. But it's also as sensitive that we have an outlook right now, and the market is clearly embracing this, that growth is beginning to be a concern. And if that sort of metastasizes over the next quarter, 2 quarters, 3 quarters, you might want to be a little bit less credit sensitive in the corporate sectors at this point in time. Which is why at PIMCO, we're sort of looking at the environment, looking at the landscape, and diversifying into higher quality sectors, agency mortgages, asset-backed securities, things that are more insular in those left tail, risk off, and lower growth enviirments, so that the susceptibility to portfolios.
You don't have a lot of high yield in the BOND fund, I gather.
Correct. That and even in our more income-oriented strategies like a PYLD, we're sort of thinking about it as an element, but not necessarily an emphasis. And that's where we're focusing on the diversification aspects of being in the markets right now. But it does get you to the point, Bob, of having a 4+% type of distribution yield, of yield to maturity, plus some total return potential, which is ultimately the other side of the coin, where investors are going to see that their total returns and their risk-adjusted total returns are what people are really going to focus on as rates become down and if volatility remains, at the forefront of people's minds.
Yeah, risk-adjusted return becomes very important in a slowing economy when you're dealing with high yield. I found that out the hard way.